The system isn't designed to help you build wealth, it's designed to take it the moment you do. Think of your wealth as water flowing into a bucket. You spend decades of your life filling it, working, saving, investing, building a business. But what you don't see is that the bucket has invisible holes drilled into the bottom: tax holes, lawsuit holes, creditor holes, inflation holes. The more water you pour in, the faster it drains out. And here's the part they never tell you: the holes get bigger as the bucket fills. An analysis of asset seizure data from the IRS, civil court records, and bankruptcy filings over the past 15 years shows an undeniable pattern. The average person who builds significant wealth will lose a huge portion of it to systemic extraction through taxes, lawsuits, creditor claims, and forced asset sales before they die. This doesn't happen because they made bad investments. It's not because they spent recklessly. It's because they never learned how the protection system works. This protection system is the invisible infrastructure the wealthy use to seal their bucket. It's not about earning more, it's about defending what you've already earned. And the rules are written so that only people who know the game can play it. Here's the core mechanism. In this country, your assets are legally exposed by default. That means creditors, lawsuits, the IRS, ex-spouses, and opportunistic lawyers can see your bucket and drill new holes whenever they want. But the law also provides a second system, a hidden layer of legal structures that can make your bucket invisible, untouchable, or legally out of reach. The poor keep their assets in their own name. The wealthy hide them behind walls made of paper. There are four main extraction tunnels the system uses to drain that bucket. Tunnel 1 is the tax escalator. As your income climbs, the tax brackets climb with you. The IRS takes a bigger slice of every single dollar you earn. But here's the trick: income is taxed heavily, but ownership is taxed lightly. If you own assets in your personal name, the IRS sees you. If you own them through a legal entity, an LLC, a trust, a holding company, the IRS sees the entity, and the entity plays by a different set of rules. The wealthy don't earn paychecks. They own structures that generate distributions, and those distributions pass through tax-efficient filters before they ever hit a personal bank account. Tunnel 2 is the lawsuit magnet. The more visible wealth you have, the bigger the target on your back. Lawyers don't sue broke people. They sue people with assets worth seizing. If you own a rental property in your name and someone slips on the driveway, they can sue you personally. They can go after your house, your cars, your savings. If that exact same property sits inside an LLC, the lawsuit stops at the LLC. Your personal assets are behind a legal firewall. The lawsuit can drain the LLC, but it cannot touch you. That's the liability shield. Tunnel 3, the creditor vacuum. If your business fails, if you default on a loan, if you co-sign for someone who vanishes, creditors can seize everything tied directly to your name. They freeze your bank accounts, put liens on your property, garnish your wages. But if your assets are owned by an irrevocable trust or a protected LLC, creditors hit a legal wall. They can get a judgment against you, but they can't touch the assets you don't technically own. This is called charging order protection. The creditor can't liquidate the LLC or force a distribution. All they can do is wait, and most of them just give up. Finally, Tunnel 4 is the divorce drain. 50% of marriages end in divorce, and in most states, anything you own personally is split right down the middle. But assets held in certain types of trusts, especially irrevocable trusts created before the marriage, are often completely excluded from marital property. The wealthy don't wait for the marriage to fall apart to protect their bucket. They build the walls before they ever say "I do." So why don't more people protect their wealth? The answer is something I call the visibility trap. Here's how it snares you. When you start making money, you feel proud, and you should. You want to see your name on things, on the deed to your house, on the bank account, on the business registration. It feels like tangible proof that you finally made it. But that pride, that desire for visibility, is the psychological hook the system uses to keep you completely exposed. The trap makes you believe that owning something and controlling something are the same. They are not. The wealthy have understood this distinction for generations. They control billions of dollars in assets they don't actually own personally. Those assets are owned by trusts, by LLCs, by holding companies, by legal entities that they control, but which exist separately from them. There's an emotional barrier, too. Asset protection feels complicated. It sounds like something for billionaires with teams of expensive lawyers. So most people put it off. They tell themselves, I'll set that up later, once I have more to protect. But that's the critical mistake. By the time you feel you have enough wealth to protect, you've already become a target. The lawsuit is already on its way. The audit has already been triggered. The creditor is already moving to freeze your account. You cannot build a bunker while the bombs are falling. There's also a fundamental misunderstanding of the system. Most people trust it to be fair. They believe that if they just work hard and follow the rules, they'll be protected. But the system isn't designed to protect you, it's designed to extract from you. The rules are written to favor those who understand legal structure over those who simply work hard. This isn't a conspiracy theory, it's just how the law is written. This leads to the most important pivot in financial thinking. The poor own everything personally. The rich own nothing personally. Let me paint you a picture. The typical approach is this. You earn a salary, which gets taxed at the highest possible rates. You buy a house in your name. You open a bank account in your name. You start a business as a sole proprietor. Your name is on everything. So if anyone sues you, they sue you. If your business fails, your personal assets are on the line. Your financial bucket is wide open for anyone to dip into. Now, contrast that with the wealthy approach. They don't earn salaries, they take distributions from LLCs or S Corps, which are taxed more favorably. They don't own real estate personally, they hold each property in its own separate LLC, so a lawsuit against one property can't touch any of the others. They don't keep large amounts of cash in personal bank accounts. They move it into irrevocable trusts where creditors can't reach it. They don't own their business in their name. They own it through a holding company, which in turn owns the operating company, creating multiple legal firewalls between them and any liability. Here's the key insight. The wealthy don't avoid the system. They leverage it. They use the exact same laws, the exact same courts, the exact same IRS code that you do. But they structure their ownership to build walls around their bucket so that even if someone manages to drill a hole, the water stays protected behind multiple barriers. They even use geography as a legal shield, a practice called jurisdictional arbitrage. They'll set up their trusts and LLCs in states like Nevada, South Dakota, or Wyoming, not because they live there, but because those states have the strongest legal protections in the country. So, how can you start sealing your own bucket? Let me be clear, this is for educational purposes. I am revealing the system, not managing your portfolio. You must consult with a qualified asset protection attorney and CPA before you do anything. But here's the blueprint. Step 1. Separate your risk from your assets. If you own a business, create a holding company that owns all the valuable assets, the real estate, the equipment, the intellectual property. Then have that holding company lease the assets to your operating company. If the operating business gets sued, the valuable assets are safe in the other entity. Step 2. Use single asset LLCs for high-risk property. If you own multiple rental properties, never hold them all in one LLC. Give each property its own. If a tenant sues over an issue at one property, the lawsuit stops at that single LLC. Your other properties are untouchable. Step 3. Move personal assets into an irrevocable trust. Once assets are in this type of trust, you no longer legally own them. The trust does, and creditors cannot seize what you do not own. Yes, you give up direct control, but you can structure it so you can still receive distributions. Step 4. Layer your entities. This is the gold standard. For example, you own a rental property inside an LLC, but instead of you owning that LLC, you have your irrevocable trust own the LLC. Now there are two legal walls between you and a lawsuit. Most predators will give up. Step 5. Use the right geography. When you form an LLC, form it in a state with strong charging order protection, like Wyoming or Nevada. In those states, if a creditor wins a judgment against you, they can't force your LLC to sell assets. They can only get a court order to receive distributions, which you as manager might never decide to make. It creates a legal stalemate that protects you. Step 6. Get an umbrella insurance policy. This is your first, cheapest line of defense. A $2 to $5 million policy is a must, but insurance has limits and exclusions. Your legal structures protect what insurance won't. Layer them together. Here is the final truth. The system doesn't reward the hardest workers. It rewards the people who understand the rules. You can spend 30 years filling your bucket with a slow leak, or you can spend 30 days learning how to seal it. The moment you start building wealth, the extraction begins. The only question is whether you're going to let it happen or if you're going to build your walls first. The game is rigged, but the rules are written down. Learn them, use them, protect what you build.